Okay, so you want to own a satellite company. Somewhere above your head right now, a piece of hardware worth hundreds of millions of dollars is traveling at roughly 17,000 miles an hour, and no human being will ever touch it again. Not to fix it, not to upgrade it, not to reclaim it if the business plan underneath it turns out to be wrong. Whatever mistake was built into that machine before launch day is now a permanent, unchangeable fact for the next 10 to 15 years. That is the single strangest condition of any business on Earth, or more accurately, off it, and almost nobody who romanticizes owning a satellite company has actually sat with what that condition really means. Let that sink in against a real number. On August 26, 1999, a company called Iridium filed for the 9th largest bankruptcy in American history. At the time, one of the biggest corporate collapses this country had ever seen. Not because anything broke. Iridium had just finished building and launching 66 satellites into low Earth orbit, creating a fully working global telephone network that let you make a phone call from literally anywhere on the surface of the planet. The middle of the ocean, the top of a mountain, the Sahara Desert. It took 13 years and roughly $5 billion to build. It launched commercial service in November 1998. Less than a year later, the company was bankrupt. Its satellites were briefly scheduled to be deliberately steered into the atmosphere to burn up as scrap, and the entire $5 billion network was eventually sold out of bankruptcy for $25 million. Half a penny back for every dollar that went into orbit. Here's what should genuinely stop you. Nothing about the technology failed. The satellites worked exactly as engineered. The phone calls connected every time from anywhere on the planet exactly as promised. And the company still went bankrupt in under a year because the thing it built was aimed at a world that had quietly changed while it was being constructed. And once you've launched, there is no version of going back to the drawing board. That's the entire economics of this industry, compressed into one story. By the time this video is over, you will understand exactly how much it really costs to build and launch a satellite business. Why the revenue model has to be locked in years before the hardware ever leaves the ground. Why this is one of the single most irreversible capital bets in modern business, what specifically killed Iridium, and 21 years later, a company called OneWeb in almost exactly the same way. And why one operator today appears to have finally cracked the formula that bankrupted every company that tried before it. If you walk away from this video only remembering one thing, make it this. In every other business we've covered on this channel, a bad decision costs you money. In this one, a bad decision gets bolted to a rocket, and you find out whether you were right about a decade-long bet, only after it's already too late to change your mind. Satellite company sounds like one industry. It's actually four very different businesses that happen to share a launch pad. A communications satellite operator, think Iridium, Intelsat, SES, sells bandwidth and connectivity, phone service, television broadcast, data links. This is the oldest and most established category. A broadband constellation operator, Starlink, OneWeb, Amazon's Kuiper project, is a newer, structurally different business. Instead of a handful of large satellites, it deploys hundreds or thousands of smaller ones working together in low Earth orbit to blanket the globe in internet coverage. An Earth observation company, Planet Labs, Maxar, doesn't sell connectivity at all. It sells imagery and data. Agricultural monitoring, disaster response mapping, government intelligence contracts, shipping and supply chain tracking from orbit, and a navigation satellite system, GPS, Galileo, GLONASS, WAMI, is almost always government-owned and government-funded rather than a private commercial venture, because the economics of building a navigation system that anyone can use for free forever essentially only work as a state-funded public utility. This script focuses primarily on the first two categories, communications and broadband constellations, since those are the models where a private company genuinely owns the hardware, carries the capital risk, and lives or dies on the revenue it can generate. The underlying lesson, though, applies to all four. Whatever you build in orbit, you're building it once, and you're building it years before you'll know if the market still wants it. Here's where satellite economics start to feel almost unreal compared to any other business on this channel. You pay the entire construction and launch cost before you have generated $1 of revenue, and you pay it in a currency that cannot be refinanced, discounted, or negotiated down after the fact. A single geostationary communications satellite the large, traditional kind that sits in a fixed orbital slot 22,000 miles up. Typically costs somewhere between $150 and $300 million just to design and build, largely because of the redundant, radiation-hardened electronics and the specialized transponders, which alone can run close to $1 million apiece and need to be built in triplicate or quadruplicate for reliability. Then there's launch, a genuinely separate, brutal cost. Putting that same geostationary satellite into orbit runs another $150 to $400 million for the launch vehicle alone, depending on the rocket and the orbit. Added up, and a single traditional communications satellite, fully built and in orbit, commonly costs $300 to $700 million before it has carried a single phone call. The broadband constellation model changes the math but doesn't remove the pain. It just spreads it across volume. Instead of one $300 million satellite, you're building hundreds or thousands of smaller ones. Individual small satellites can now launch for as little as a few $1,000s per kilogram thanks to reusable rockets and rideshare programs, a massive improvement from a generation ago. But multiply that by a constellation of 600, 1,000, 200, or in some proposed networks, tens of thousands of satellites, and the total capital requirement for a broadband constellation routinely runs into the billions to tens of billions of dollars before commercial service ever launches. And this is before ground infrastructure. The network of ground stations, gateway antennas, and terrestrial data centers needed to actually route the signal from orbit to a customer's device, which for a global network adds hundreds of millions more. The uncomfortable truth sitting underneath all of this: unlike a golf course or a casino, you cannot build a satellite network in phases and generate revenue as you go with any real flexibility. Most business models let you open one location, prove the concept, then expand. A satellite constellation frequently needs a meaningful fraction of its full network in orbit before it can offer a genuinely competitive commercial service at all, meaning most of the capital has to go up before the company knows for certain the market will pay for what it built. 3. The sky doesn't forgive mistakes. If a casino builds the wrong kind of restaurant, they renovate it. If a gym buys the wrong equipment, they sell it and buy different equipment. If a golf course's irrigation system fails, a crew drives out and fixes the pump. None of that exists once a satellite is in orbit. There is no repair truck for a communications satellite 22,000 miles above the Earth. If a component fails, in almost every case, it simply stays failed for the rest of the satellite's operational life. Engineers on the ground work around it with redundant systems if the satellite was built with enough redundancy, or they don't, and that capability is gone permanently. If the market shifts, a competitor launches a better network, a new technology makes the original design obsolete, regulatory rules change the spectrum you're allowed to use. You cannot retrofit a satellite that's already in orbit to meet the new reality. You can only wait for it to reach the end of its operational life, which for a large geostationary satellite is typically 15 years, and build the next generation differently. This is, without exaggeration, one of the most irreversible capital allocation decisions in business. A satellite operator commits hundreds of millions or billions of dollars to a specific technical design, based on assumptions about the market, competition, and technology that have to hold true for over a decade, with essentially zero ability to course-correct the physical asset once it launches. Insurance exists for exactly this reason, and it's its own significant cost center. Launch insurance and in-orbit insurance for a major satellite can run 15 to 20% of the total asset value annually in the early years, reflecting how genuinely risky the launch phase and early operational phase are. A single failed launch can destroy hundreds of millions of dollars of hardware in a matter of seconds, with no way to recover the physical asset at all. Given all of that risk and irreversibility, here's how a satellite company is actually supposed to make its money back. Bandwidth leasing is the foundational revenue stream for communications satellites. Telecom carriers, broadcasters, and government agencies pay to lease transponder capacity, essentially renting a slice of the satellite's total communication capability for a monthly or annual fee, often locked into multi-year contracts signed before the satellite even launches. Direct-to-consumer subscriptions are the newer model, powering the broadband constellation business. A monthly fee from individual households and businesses for internet access, priced to compete with terrestrial broadband in areas that traditional fiber or cable can't reach economically. Government and military contracts are a major and often underappreciated layer. Defense communications, weather monitoring, and reconnaissance imagery routinely come with long-term, high-value government contracts that provide a stability civilian bandwidth leasing alone doesn't offer. Data and imagery licensing, for Earth observation operators specifically, means selling access to processed satellite imagery and analytics, BIDs, agricultural yield predictions, shipping traffic analysis, disaster damage assessment, to corporate and government clients on a subscription or per-image basis, in intersatellite and backhaul services, selling connectivity between satellites themselves or between a constellation and terrestrial data infrastructure, is a smaller but growing layer as networks become more interconnected. Here's the mechanic that makes this genuinely different from every other business on this channel. Because the upfront capital cost is so enormous and irreversible, and the operational life of the asset is measured in a decade or more, a satellite company's entire revenue model has to be locked in through pre-signed contracts, anchor customers, and government commitments, largely before the satellite launches. You're not building the network and then finding customers. In the traditional model, you're supposed to have found the customers first, and the network is built to serve contracts that already exist. When that sequence gets reversed, when a company builds first and hopes the customers show up, that's exactly the setup that has produced almost every major bankruptcy in this industry's history. VBAT, the Icarus problem. Here's the structural risk that makes satellite companies uniquely dangerous compared to almost any other capital-intensive business. By the time you finish building what the market wanted, the market has often moved on to wanting something else, and you cannot unlaunch a satellite. This is fundamentally a technology timing risk, and it's different from the leverage or competition risks we've covered in casinos or golf courses, because it's not about being outspent by a rival. It's about the years-long lead time between deciding what to build and actually having it operational, during which the entire technological and competitive landscape can shift underneath a project that cannot be redesigned mid-flight. Satellite phone companies in the 1990s spent a decade and billions of dollars building networks explicitly designed to solve a problem, making a phone call from anywhere on Earth. The terrestrial cell towers were simultaneously and much more cheaply solving on the ground, at the exact same time these satellite networks were being finished. The satellite companies weren't wrong that the problem was real in 1987 when they started. They were catastrophically unlucky or underprepared for how fast and how cheaply the terrestrial alternative would scale by the time their systems were actually ready in 1998 and 1999. Add to that the regulatory risk. Orbital slots and radio spectrum are licensed and allocated by international and national regulators, and a company can spend years and hundreds of millions securing the rights to operate in a specific frequency band or orbital position, only to find a competitor or a regulatory ruling narrows what they're actually allowed to do with the asset they already built. And there's a newer, physical version of this same risk emerging today. Orbital congestion. As more companies launch more satellites into the same useful low Earth orbit altitude bands, the risk of collision and the resulting cascade of space debris that can damage or destroy other satellites is becoming a genuine operational and insurance cost that didn't meaningfully exist for the previous generation of satellite operators. Let's go back to Iridium, because the story is worth understanding in full, not just the headline number. Iridium was conceived by Motorola engineers in 1987, with the pitch being genuinely visionary, a constellation of 66 low Earth orbit satellites that would let any handheld phone connect to any other phone, anywhere on the planet, with no dependence on ground infrastructure at all. Development took over a decade and consumed roughly $5 billion in capital, funded by Motorola and a syndicate of international investors. The satellites were built, tested, and successfully launched. The technology worked exactly as designed. Commercial service launched in November 1998, priced at several dollars a minute, with handsets costing thousands of dollars each. Expensive, but justified by the genuinely unique capability. Coverage anywhere on Earth, including oceans, deserts, and polar regions where no cell tower could ever reach. The problem was the calendar. During the exact same decade Iridium spent building its network, terrestrial cellular networks expanded explosively across the developed world, becoming cheaper, more convenient, and covering the vast majority of places people actually needed to make calls. Iridium's core pitch, a phone that works anywhere, was true. But for the overwhelming majority of potential customers, anywhere had quietly stopped being the problem they needed solved, because their phone already worked almost everywhere that mattered to them. By May 1999, 6 months after commercial launch, Iridium had signed up only about 10,000 subscribers. Nowhere close to the roughly 50,000 plus it needed just to meet the terms of its debt covenants, let alone turn a profit. It defaulted on $1.5 billion in debt and filed for Chapter 11 bankruptcy in August 1999, becoming one of the largest corporate bankruptcies in U.S. history to that point. What happened next is the detail that makes this story genuinely remarkable rather than just a cautionary headline. With the company in bankruptcy and no buyer found, Motorola and the bankruptcy court seriously considered the alternative, deliberately deorbiting all 66 satellites, letting them burn up in the atmosphere, because the cost of continuing to operate a network with no viable business model exceeded the value anyone was willing to pay for it. At the last possible moment, a private investor group stepped in and purchased the entire constellation, 66 working satellites, ground infrastructure, and the underlying technology, for approximately $25 million, roughly half a cent back for every dollar that had gone into orbit. The satellites didn't fail. The engineering was sound. The company failed because it built an extraordinarily expensive solution to a problem that a cheaper, terrestrial alternative solved faster than Iridium could finish building. If Iridium were an isolated story, you could write it off as a one-time miscalculation from an earlier, less sophisticated era of the industry. It wasn't. 21 years later, in March 2020, a broadband satellite company called OneWeb filed for Chapter 11 bankruptcy after raising a combined total of roughly $3.4 billion from investors including SoftBank, Virgin Group, Qualcomm, and Airbus. OneWeb's plan was to build a constellation of 648 low Earth orbit satellites to deliver broadband internet globally, directly competing in the same broad category that would soon be dominated by SpaceX's Starlink. By the time it filed for bankruptcy, OneWeb had successfully launched only 74 of its planned 648 satellites. It had laid off roughly 85% of its workforce trying to conserve cash. According to bankruptcy filings, OneWeb owed its launch provider Arianespace $238 million alone, more than any other single creditor. A stark reminder that even the cost of getting hardware into orbit becomes a source of existential financial risk when a company's broader funding runs dry mid-construction. Independent industry analysts estimated at the time that fully building out OneWeb's satellite system would have required as much as $7.5 billion, more than double what the company had actually managed to raise before the money ran out. OneWeb wasn't undone by a single dramatic failure. It was undone by the same mechanism that undoes most satellite companies, a capital requirement that turned out to be dramatically larger than the initial funding could support. In a business where you cannot pause construction, generate partial revenue, and resume later without losing your competitive position entirely. OneWeb eventually emerged from bankruptcy after the UK government and Indian conglomerate Bharti Global jointly invested $1 billion to acquire the company and has continued deploying its constellation since, making it one of the rare satellite bankruptcies with a genuine second act. But the mechanism that put it into bankruptcy in the first place is exactly the same one that sank Iridium 2 decades earlier. An industry where Space News, the trade publication covering this exact story, noted that OneWeb joined the ranks of Iridium, Globalstar, Orbcomm, and Teledesic, a list of satellite companies that ran out of money trying to build large communications constellations, spanning 2 full decades of the same lesson being learned the hard way, company after company. Here's what's genuinely important for understanding where this industry is heading. The operator that appears to have finally cracked the economics that killed Iridium, OneWeb, Globalstar, and Teledesic, isn't following a fundamentally different business model. It's following the same model with 2 structural advantages none of its predecessors had. The first is launch cost. Reusable rocket technology has driven the cost of putting mass into orbit down by a genuinely staggering amount over the past decade. By some industry estimates, launch costs have fallen over 95% since the era before reusable boosters. A company that owns its own launch vehicles, rather than paying a third party like Arianespace per launch the way OneWeb did, controls the single largest variable cost in this entire industry, instead of being at its mercy. The second is manufacturing philosophy. rather than building a small number of enormous, exquisitely engineered, individually irreplaceable satellites the way Iridium and traditional geostationary operators did. A mass manufacturing approach treats each satellite more like a mass-produced consumer product, smaller, cheaper, built on an assembly line, and explicitly designed to be replaced every 5 years rather than engineered to last 15. That single design philosophy shift changes the entire risk profile. If a design assumption turns out wrong, or a market shifts, you're not locked into a 15-year-old piece of hardware. You correct course on the next production run, which might be only months away, not years. This is the genuine structural lesson underneath the entire history of this industry. The companies that failed weren't wrong about demand existing. They were locked into capital-intensive, slow-to-build, impossible-to-modify hardware for a decade, plus at a time, in a market that moved faster than their hardware could adapt. The company that succeeded controls its own launch costs and builds hardware cheap and disposable enough to iterate on almost as fast as a software company would. The successful trajectory. A satellite operator secures anchor customers and government contracts before finalizing the network design, locking in revenue commitments that will exist regardless of how the broader market shifts during the build period. It controls its own launch costs, either through a long-term launch agreement at favorable rates or by owning launch capability outright, insulating itself from a third-party launch provider's pricing and schedule risk. It designs for a shorter operational lifespan with lower per-unit cost, preserving the ability to redesign and relaunch within a few years rather than being locked into a single technical bet for over a decade. Insurance costs stay manageable because the launch cadence is proven and reliable. The company reaches commercial service with a customer base and revenue already substantially in place, rather than hoping to find one afterward. The failed trajectory. A satellite operator raises capital based on a total build-out cost estimate that proves significantly too low, common enough in this industry that it has its own informal name among analysts: chronic underestimation of true constellation cost. Revenue contracts are signed provisionally or not at all before construction begins, on the assumption that customers will materialize once the network is operational. The company depends on third-party launch providers at market rates, exposing it to schedule delays and cost increases entirely outside its control. Development takes long enough, often the better part of a decade, that the original technological or competitive assumption the entire business was built on has shifted by the time the network is finally operational. When the capital runs out mid-construction, there is no partial version of the product to sell. A constellation that's 1/3 built generally cannot generate 1/3 of the intended revenue because customers need close to global coverage to find the service genuinely useful. The gap between those two trajectories isn't really about the quality of the engineering. Iridium's engineering worked. It's about whether the revenue was locked in before the capital went into orbit and whether the company controlled the one truly irreversible cost in this entire industry: the price of getting mass into space in the first place. So does owning a satellite company actually work as a business? The honest answer is, it can, decisively, but it is one of the least forgiving capital structures in modern business because it demands you commit the overwhelming majority of your capital based on assumptions about technology and demand that have to hold true for the better part of a decade to an asset that cannot be repaired, redesigned, or retrofitted once it leaves the ground. The romance of owning a satellite company is the genuine, almost science fiction scale of the achievement. Building a machine that operates in space, connecting the planet from 22,000 miles up. The mechanics underneath it are a business where the single biggest decision you'll ever make, what to build and for whom, has to be right years before you'll find out whether it was, with no meaningful way to change course once the rocket leaves the pad. The operators who make it work aren't the ones with the most ambitious technical vision. Iridium had that, and it isn't enough. They're the ones who understood, going in, that the actual product wasn't the satellite. It was the discipline to know exactly who was paying for the network before a single dollar went into building it.